The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe with Karen Cho, Juliana Tattlebaum and myself, Steve Sedgwick. And these are your headlines. Well, the president, Mr. Trump, has threatened substantial levies on copper and the pharma sector as the EU scrambles to agree a tariff deal. The US Commerce Secretary Howard Lutnick says the two sides are making progress.
The European Union, to their credit, has now made significant real offers. The president's got those deals on his desk, and he's thinking about how he wants to play them.
Meta bets on EssilorLuxottica, reportedly asking a $3.5 billion minority stake in the Ray-Ban maker as the US tech giant makes a push in the smart glasses space.
And Elon Musk lashes out at one of the most bullish Tesla analysts on Wall Street, telling Dan Ives to shut up after he called for Musk to cut back on politics.
President Trump says he will impose a 50% tariff on all copper imports into the US. That puts it on a par with levies on steel and aluminium, or if you're American, aluminum, potentially impacting the production, as Karen mentioned, of EVs, military hardware, power grid infrastructure. The US Commerce Secretary Howard Lutnick told this very channel he expects the new tariff to come into force by the end of July what's the difference between the end of July and beginning of August? Anyway, by the end of July or the beginning of August. Look at the price of copper anyway. It is up 12% on the September delivery. LME down 2%. There you go, because there's going to be potentially a transfer of where that copper goes, isn't there? Trump's copper tariffs saw prices in the US spike more than 10%. The largest intraday gain going back to at least the late 1980s. However, prices on the LME, the global benchmark, ticked slightly lower, reflecting a tighter US market. Ergo, that copper will probably try and find another home, some of it, elsewhere. So you're going to have perhaps an oversupply, an abundance of supply in the rest of the world. US Commerce Secretary Howard Lutnick told our US colleagues reshoring the production of copper and other metals to America is a key part of the Trump administration's industrial strategy.
So copper is finished. We've done with our study. We've handed the study over to the president. The president knows that he has the ability, since we've studied the market of copper, to set the market tariff for copper. He announced it today at the cabinet meeting that he intends to go to 50%, which will be similar to steel and aluminum, which are both 50%. So copper will be 50%. And the idea is to bring copper home, bring copper production home, bring the ability to make copper, which is key to the industrial sector, back home to America. We need that kind of production in America. It's important.
Trump also threatened to raise tariffs on pharmaceutical imports by as much as 200%, with an announcement on that and semiconductors coming soon. In April, Trump ordered the Commerce Department to launch an investigation into the U.S.'s supposed reliance on foreign drug production and the national security implications.
Trump says the European Union is likely to receive a letter outlining his tariff plans in coming days, but stressed the bloc has been treating the U.S., quote, very nicely. This morning, the Financial Times is reporting that Brussels is ready to sign an agreement in principle that would set the U.S.'s so-called reciprocal tariffs at the 10% baseline, while negotiations continue. It adds the EU is ready to concede tariffs on its goods will be higher than those imposed on the UK. Commerce Secretary Howard Lutnick told CNBC the EU has offered to open up its markets to the US and that Trump is still weighing his response.
The European Union, to their credit, has now made significant real offers, meaning we're going to take down our barriers, we're going to open our markets to American farmers, ranchers, fishermen, really open their markets and let Americans finally, American entrepreneurial spirit, finally get to sell to Europe. The president's got those deals on his desk, and he's thinking about how he wants to play them. And this is very tricky because they have a huge trade deficit, so they've got to pay, but they're really going to bat trying to say, look, we want to open our markets to you. We want to create a more balanced and fair relationship.
Right, let's get to a very important voice on this. Peter Chase is Senior Fellow at the German Marshall Fund as well. Peter, thank you very much indeed for joining us out of Brussels today. We don't know what the president's going to say next, obviously. He's keeping us all on tenterhooks ever since the start of April as well. But the fact is, the language from the president in previous incarnations has been actually Europe is as big an enemy as China. Now, I'm not saying there's a rapprochement, but the language at the moment is conciliatory. It's talking of collaboration. It's talking about a deal. Are you anticipating actually that the EU and the US can get a deal?
Yes, they'll get a deal. I'm not sure what that deal will be. I'm not sure how long it will last because things will change. It's possible that the president is being more conciliatory, as he put it, because he is beginning to understand that the relationship between Europe and the United States is not a trading relationship, it's an investment relationship. European companies have $2.4 trillion invested in America, 2.4 trillion. That's huge. They're among the biggest manufacturers of industrial products in the United States. European companies are. The trade between us is trade that's intra-company. It's within Siemens or GE or Ford. Those companies trade back and forth between their European and their American operations. So it's a very different set of trading relationship or economic relationship than one that we have with Japan or China, or for that matter, even Canada.
Yeah, that's a very interesting point, Peter. And of course, a lot of European leaders were speaking to us three over the last 4 years and saying, look, because of IRA, we want to base our new capex in the States rather than in Europe as well. Peter, this 10% that appears to be doing the rounds, that the British have accepted, that the Europeans may well accept as a blanket tariff increase as well, is that acceptable, do you think, to European business? Is it the right thing for Europe to do? I mean, it's a bitter pill for many, I would guess, having an extra 10% on their goods going to the States.
I think that's the wrong question. Is it acceptable to American business would be a better question. Again, the vast majority of things that Europe exports to the United States are not consumer goods. They're not shirts and shoes, but they're inputs for things that businesses in the United States manufacture. And without those things, if I'm a business in the United States, that gets in the way of me doing business. So, it's the importer who pays the tariff, not the exporter. The tariff, that if the Europeans have a tariff of 10% and Korea has a tariff of 25%, then Europe, while an American business is paying more for the same product from Korea than it would be paying for one from Europe. So it's not, European businesses will, they'll deal with it, but it's the American customer that's the one that will be paying for it.
Peter, can I ask about the distortions, though, that we could see for Europe? Because as steel and aluminium over the years have been targeted with tariffs, Europe has been aware that it could be a dumping ground for some of the products. Now, as we talk about a 10% extra for the BRICS countries on products, as we talk about copper being caught up on importation tariffs, where do you think we land in terms of distortions that Europe will also have to manage?
There will be a lot of distortions, I'm sure, but one of the things that, again, you were talking about this earlier when you were talking about copper. The question is, can America substitute imported products with domestically made products, and how quickly? These tariffs are going to go up, and they go up overnight. But businesses in the United States and customers in the United States can't change their buying practices overnight because there isn't a domestic supply. So there, in that sense, the things that we used to buy before the tariffs, we still need to buy after the tariffs. That means the immediate impact is on domestic prices in the United States rather than on a change in supply. It's not that people are going to stop exporting to the United States. Americans will start paying more. I don't know how this is a good deal for America, but Mr. Trump seems to think it is.
Well, Peter, let's just take that a little bit further. The products we're now talking about go right to the heart of the AI build-out, the AI infrastructure build-out, copper, very much part of that mix. Does that mean we're talking about a much more expensive technological build-out?
For the United States, absolutely. Just like, steel there are a whole bunch of different grades of steel, right? And the steel that's used in a Caterpillar tractor is different from steel that's used in building a building. The steel that's used in a Caterpillar tractor, a lot of that has been imported from Germany, for instance, specialized steel. And that isn't available in the same quantities in the United States. So the people, Caterpillar, is going to have to buy the steel anyway if they want to produce their products. They just have to pay the extra 25 or 50% now. I wish that the world were as responsive to Mr. Trump's whims as he would like it to be, but it isn't. There's a reality that has to be dealt with. And the price of copper with 50% tariff is not going to mean that copper production in the United States goes through the roof tomorrow. There's a price differential, but if you want to build your computers and you need the copper, then you'll have to be buying imported copper at 50% more.
Peter, President Trump talked about his objective with these tariffs at the start of his April 2nd announcements, that this was intended to reshore, to drive a reshoring of manufacturing as well as balance trade. Do you think that his objective has changed over the course of the last 2 months?
No, I suspect that's his objective. It makes sense. But sometimes when politicians talk about reshoring manufacturing, they think of factory jobs. They want to bring back factory jobs, not just factory output. And the question is, if you bring back more production in the United States, are you actually going to employ more people? Not necessarily true. There's a lot more automation today than there was before. And where will those people be employed? Will they be employed in Pennsylvania, or will they be employed in Tennessee? So these are questions that I think he hasn't really thought through as to which of these things he wants. Manufacturing value added has continued to go up in the United States, despite the fact that manufacturing employment has been going down. Do you see what I mean? So he may think he may have an image of strong factory workers in Pennsylvania, but whether or not that will be the outcome of the policies he's adopted, I think is an open question and pretty dubious, actually.
Peter, certainly do know what you mean. Thank you for the conversation. Lots of food for thought. Peter Chase, Senior Fellow, German Marshall Fund. Coming up on the show, OPEC holds its international seminar in Vienna just days after agreeing its latest output hike. We'll be crossing live to Dan in the Austrian capital. Plus, Elon Musk lashes out at Tesla bull Dan Ives. We'll bring you the details of that spat. And Arjun will be joining us live from the Louvre, which is staging this year's Raise Summit. He'll be joined by the CEO of French AI upstart H Company. That is coming up at 9:30 London time. Welcome back to the program. Let's get you a check on markets. You can see yesterday U.S. equities ended little change. Investors taking more tariff headlines in stride. The S&P 500 ending a touch light. The Dow Jones did pull back about 0.4%. The Nasdaq ending 3 basis points higher. So remarkably steady given how much uncertainty hangs over markets in terms of those tariffs and where we land. In terms of the Asian trade, similar picture. Here's what's happening in the region. You've got the Nikkei 225 up about 17 basis points. Shanghai Composite up about 28 or so basis points. The Kospi up as well. And the Hang Seng over in Hong Kong pulling back by about 1%. As for European markets, this is what futures look like at the moment. We're about 40 minutes or so away from the European market open. Yesterday, Stoxx 600 gained 0.4%. Its fourth positive session in 5. Gains spread pretty evenly across the board. Now this morning, we're looking at more gains. So interesting story of continued European outperformance versus the U.S.
Right, OPEC and its allies agreed to hike output in August by more than expected at the weekend in the group's first meeting since last month's war between Israel and Iran. Key industry players and oil market watchers are now convening in Vienna for the alliance's international seminar. Dan joins us with plenty more from Vienna. Daniel.
Hey there, Steve. Good morning to you. Well, as you've just explained, whether it's trade or geopolitics or supply and demand, there is so much in focus on the ground here in Vienna as we see the OPEC ministers and also plenty of others inside the OPEC group and the periphery of the OPEC group descending on Hofburg Palace here to have a conversation about exactly what's happening in the second half of the year and, of course, all of these issues as well. So let me bring in your next guest here on Squawk. Very pleased to say that Bob McNally joins me now from Rapidan Energy. Bob, it's great to see you. Welcome to the program.
Great to be here in balmy Vienna with you, Dan.
Yeah, balmy's the right word, I think. Very chilly outside, yes. Bob. You've been doing this for a long time, so help me understand what is going to happen over the next couple of days here. And ultimately, Bob, what do you see as being behind this decision to ramp up output from the OPEC group, particularly in this environment? What's behind that move and why now?
Yeah, Dan, thanks for having me on. So this conference is great, and we're going to talk about the long-term alleviating energy policy, the end of the decade. Is demand for oil and gas really going to peak and collapse? But then the short term, as you mentioned, there's an interesting divergence. Reasonable people can differ about where fundamentals in oil is going later this decade. And I think OPEC Plus's decision, or the group of 8 volunteers' decision, to accelerate that tapering from 411 KBD to 538 KBD is sort of OPEC Plus putting their barrels where their mouth is. In other words, they see a tight market continuing into the second half of this year. They have demand growth year on year well over 1 million barrels a day. I think OPEC has about 1.3. And they're cautious on non-OPEC Plus supply growth, the US, Brazil, etc. So if you believe that, then the market needs more OPEC barrels, and OPEC is supplying them, Saudi Arabia and UAE particularly. There are those of us who are a little more cautious. No question. When you look out the window at the visible data, the market's tight. Cushing is about empty. Diesel inventories, especially in the United States, quite low. Curves for crude oil are backwardated. So it's a tight market. This is all about the second half, though. Partly it's a macroeconomic call. We're in unusual, if not unprecedented, macroeconomic times. Black swans aplenty, particularly with regard to tariffs and interest rates and so forth. And also there's a reasonable difference of opinion over how fast supply from Guyana, Brazil, Argentina, Canada will grow. We tend to think that we're going to enter a soft patch here in the second half of the year, but by no means do I have a monopoly on wisdom there, and reasonable people can differ.
So you're more bearish than bullish for the second half. Elaborate on that for me. What is that going to mean for prices? Because we're trading at around this 70 USD handle right now. Is it reasonable to expect that we will see a 5 handle, as some have suggested, on the price of oil before the end of this year, Bob?
I think so. We forecast Brent falling into the mid-50s range. We think the contango that now exists at the sort of back end of the Brent curve is going to roll up to the front. We think we're going to see builds in visible inventories. We think inventories are building in the second quarter in less visible parts of the non-OECD, China and so forth, at sea. But in our view, you're going to start to see softness materialize in the front of the curve, the front of the market, and you'll see spot prices come off. That's our view.
Okay, so what is that going to mean for investment into this industry? Over in the United States, the president's talking about drill, baby, drill. Giovanni Stranovo at UBS told me today maybe it's more like chill, baby, chill in this environment. But on the other side, you also have OPEC adding barrels, and they are really validated by what they're seeing on the demand side right now, yes?
Yeah, that's right. No, that's right. So far, they are validated. When I talk to our clients who are thinking about making long-term investments in energy and oil and gas, less important are the gyrations day to day. The shale patch, Texas, is none too pleased about $50 oil or lower. They don't like that message at all. However, in my view, a bigger dampener on investment is this consensus, this persistent consensus that developed about 4 or 5 years ago, that global oil demand and global gas demand is on track to decouple from GDP, fall, and peak by 2030, with the debate being whether it plateaus or collapses thereafter. It's that medium to longer term demand outlook which is the bigger sort of bummer, if you will, for those thinking about investments in oil.
Talk to me about the biggest black swan that you see in this market right now as well, because it's been suggested to me that the geopolitics is still a clear concern here. Yes, there was no immediate impact on supply through the Israel-Iran conflict, but at the same time, the Iranian foreign minister writing an op-ed for the Financial Times in the last 24 hours saying Iran will not be pushed back to the nuclear negotiation table with the United States and will not negotiate under threat. Do you think markets might be underpricing the risk of another Middle Eastern flare-up?
You know, I think they are, and geopolitics is by far the biggest black swan near term. What comes after, though, would be macroeconomic risk, particularly from the United States. But, you know, the market understandably has been shrugging off these false alarms. We've been getting them since late 2019, September, when the Iranians attacked Abqaiq, the Russian invasion of Ukraine, $127. We've been falling ever since. Israeli-Iranian flare-ups and a mini war, only a brief spike. So it's understandable. I don't want to be too dismissive or critical of the market's skepticism. However, as you pointed out, we are not out of the woods with Iran. What we believe in here is that the last 20 years of just sort of kicking the can down the road with Iran is likely to come to an end. We are heading to where we're going to have either a diplomatic deal, lifting of sanctions, and a more benign scenario, or I think we're just setting up for the next round of conflict, especially if Iran attempts to go for a bomb or refuses to negotiate or even reconstitute its sort of shattered air defense system. So we are not out of the woods yet.
I've been saying for a while that the Middle East doesn't really do clean exits. It kind of just does cycles, escalation to de-escalation and beyond. What's the next flashpoint we should be watching then?
Well, the next flashpoint will be whether or not we can get to a deal or a negotiation with Iran. So far, President Trump has backed off of this maximum pressure. We've been increasing our estimate of Iranian exports. We had assumed President Trump would sort of crack down, but he's very nervous about oil prices. This is why you see an easier policy with regard to Russia oil sanctions and now Iran. But I think they're going to give talks a chance. The president, he's perhaps the only president who would have ordered a preemptive strike on Iran, but he's also the only president who would do a deal, even with this regime, with Iran. And so the biggest flashpoint is whether we get into a deal dynamic, whether the Iranians feel desperate enough, despite their bluster, to come to their senses and do a deal, in which case things could get quite bearish, or with Israel impatient to prevent Iran from sort of recovering and resuming its activities, and President Trump unwilling to accept a nuclear-capable Iran, whether we cycle into another round of conflict. That is probably the biggest question facing oil markets near term on the geopolitical front.
Indeed, not to mention everything that's happening with the macroeconomics and, of course, Trump's trade and tariff agenda also impacting market sentiment and direction. Bob, love the conversation. Thanks so much for coming on today. Always appreciate it.
Thank you, Dan.
That is Bob McNally there from Rapidan Energy. And with that, it's back over to you.
Thank you very much for that, Dan. Looking good there. Now, Starbucks China has attracted offers for a potential stake sale, valuing the coffee chain at up to $10 billion. 3 people familiar with the deal process have told CNBC. Almost 30 domestic and foreign private equity firms in China have submitted non-binding offers, the sources said. Adding the proposals on the table value the business at between $5 and $10 billion, with bidding expected to settle towards the higher end of that range. Fascinating story. You can check out that at CNBC.com. I know there are some domestic players that look a lot like Starbucks. What does it do to the valuation on the ground? We'll talk later on. Now, meantime, a quick look at how we're setting up on futures today. Early signals are positive. We're chasing some upside, particularly on French stocks, seen up about 1/3%. The rest of the range is a little bit more modest. Over Italian futures, less than 0.2.